Welcome. Today's Thursday, June 22nd. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder at Alpha Insights. And this is your Daily Five. Daily Five is the show where we talk about the five charts that are most top of mind for us right now. And this could be a complicated discussion, I think. So I'm going to talk very quickly, and I'm going to encourage you to, maybe do a pause if you're watching this on YouTube, or maybe just do a screenshot and read the text just to keep up. We also did a similar discussion with an option specialist by the name of Jim Struger on yourfinance.tv yesterday, and it was pretty well received. It's about a 20-minute presentation, kind of going through market structure and volatility and where we think things are headed, which is what we'll dive into. But first, let's talk about our newsletter. I just want to remind everybody that we will be publishing the next issue of Huge Insights, The Big Picture, on July 8th. This is the first Saturday following the non-farm payroll report. We typically publish on the first Saturday of the month, which is usually the Saturday following the NFP report. This time, Saturday falls on the first. So we're going to push it out a week because we like to see that jobs number before we go out there and make a big call. Bottom line is we put this out every month. It's free to subscribe. You can go to hugeinsights.substack.com and just get your name on the mailing list. It goes out via email early in the morning on Saturdays. And the newsletter is affectionately titled Huge Insights, The Big Picture, because in that newsletter, we really talk about the key macro factors affecting the economy and the markets. A lot of people, inquire as to how do they get more. Well, we do have an upgrade to paid option there. So for those who do want more, for as little as $12 a month or 39 cents a day, that's less than a postage stamp, folks. You can actually access our monthly market forecast and positioning recommendations. Our paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. That details our top actionable trade idea every week and also provides updated market commentary. This goes out every Wednesday afternoon. And in addition, paid subscribers will also receive privileged access to periodic interim bulletin reports. We just put one out like a week ago, and I think people thought it was pretty timely. And we also do quarterly video content. So you'll see some sort of institutional presentation that wouldn't necessarily, you wouldn't otherwise have access to. So we think there's a lot of value there. If you're interested, you can find the newsletter on hugeinsights.substack.com. You can also follow us on Alpha Insights or at Alpha_Insights on Twitter, and check out our website at jwhinvestment.com. Let's jump into the first chart here and get started. We've entitled this chart Black Swan Alert, and we put an exclamation point behind it because we think it is underway as we speak. The SKU index is coming off back-to-back highs of 158 and 157. This indicates that there's a real mispricing of left tail risk in the market. SKU actually measures the slope of implied volatility. And, at a level of 100, the distribution of S&P 500 log returns is considered to be normal. That would imply only about a 2.3% probability of a 2 standard deviation downside move in stock prices. As SKU increases in value, so does the risk of a left tail event. That's a high risk downside event. And a level above 150 implies about, greater than 15% probability of a 2 standard deviation downside move in stock prices. Now, VIX, which is a proxy for standard deviation, captures kind of the first layer of perceived risk in the market. SKU captures an additional layer of risk in the market. And what really high values of SKU, they can occur in conjunction with both high and low values of VIX. But when the value of VIX is very, very low, in conjunction with the high value of SKU, the risk of a black swan event is at its most elevated level. Well, yesterday, the SKU index reversed sharply lower, breaking its uptrend, while the VIX actually closed at a new 40-month daily low. In the chart, we juxtapose the two, and the question we're asking, are the alligator's jaws poised to snap shut? We think they are. We think VIX is poised to rally aggressively to the upside as SKU comes down. Let's take a look at chart number 2. Chart number 2 juxtaposes the VIX against the volatility of volatility index, or the VVIX in the lower frame. Now, investor sentiment data has turned decidedly bullish. The CNN Fear and Greed Index has gotten up to 82%. That's the extreme greed rating, and it's been there for several days. We've also seen the Daily Sentiment Index by TradeFutures.com for the S&P up in the low 80s as well. I think it got as high as 83. And for the NASDAQ, it got as high as 93. I think the 5-day average was 91. That was higher than it was back at the all-time record peak for the NASDAQ. It's very rare when you see that. But, also the AAII survey, looking at the bulls minus bears spread, has jumped 60 percentage points since the October lows. We're now at 22.5, which is extremely high for this notoriously bearish cohort. Yet, if we take a look at the VIX, the volatility index, it just posted its lowest daily close in 40 months since really the S&P topped back on February 13th, 2020, okay? Just days before the COVID crash ensued. So, this implies, in our view, a new extreme in investor complacency. However, if we take a look at the volatility of volatility, the VVIX, it actually bottomed back in January 6th, actually, and it's been diverging positively relative to its June lows. Now, historically, positive divergences between these two series have tended to precede pretty sharp trend changes in the VIX. And while the VIX has moved steadily lower in recent weeks, the VVIX has been extending its progression of lower, or I should say higher lows. And so that uptrend that's been put in place, really dating back to January 6th, has seen a sharp move upward as the VIX has made this new low. And as such, we think this positive divergence is signaling a volatility spike. It's of some significance in the days to weeks immediately ahead. In our view, we will likely see the VIX challenge its prior highs in the mid-30s, possibly exceed those. We haven't printed a VIX over 40% in 2 years. And it's my opinion that we will see a sell-off in equity markets that coincides with the VIX breaking out above that 40% level and possibly much higher. Let's take a look at chart number 3. Chart number 3 illustrates call option volume, and right now it is off the charts. Over $700 billion in call option volume. That's calls alone. And call option volumes have reached this new record extreme this month, more than doubling since 2020. And this is mainly due to the introduction of 0 days to expiration options last year, which according to BofA Global Research now accounts for greater than 50% of the daily open interest. Now, the recent hysteria over AI and AI stocks has created an enormous one-sided overcrowded long position in a number of the mega cap tech stocks. And that has created a self-reinforcing feedback loop. I think that the combination of this massive 0 days to expiration options, coupled with about $11 trillion in passive equity funds that are also seeing regular systematic 401k dollar cost averaging buys every single month, $600 billion in annual stock buybacks in these stocks, and dividend reinvestment plans, there has been an absolutely relentless bid under the market here. And what's happened is it's created a gamma squeeze, which is forcing options market makers to buy more and more stock, a la GameStop, okay? In order just to hedge their books and remain delta neutral. And this in turn has artificially distorted the traditional risk indicators by suppressing volatility. And that has thus incentivized the CTAs, commodity trading advisors, and quant funds to aggressively buy S&P futures. All of these things are culminating into a peak right here. Gamma squeezes must end. They always end. And what terminates a gamma squeeze? When the fever breaks, that's when the market rolls over. And I think stocks coming in will break this relentless cycle, and we will see something of an inordinate sell-off in stocks. Now, what could possibly make that happen? Let's take a look at the next chart, chart number 4, which looks at really the massive VIX open interest. And if we look at the VIX landscape, it gives us a sense that there's basically over 400,000 VIX contracts open in the VIX futures curve. And all this activity has been building up inertia for VIX. It's akin to holding a beach ball underwater. The deeper you attempt to push it underwater, the greater the opposing force of ballast, right? And it just goes until you can't hold it any longer. And then the beach ball explodes out of the water and pops 6 feet into the air. Well, it's exactly like that with VIX, and anything out there that's out of the ordinary could trigger a cascade of selling. But there's a number of potential catalysts that are poised to impact the market before the month is over, and any one of these could actually force volatility much higher. The first one that jumps off the page is the annual Russell reconstitution. That's going to be finalized tomorrow after the close, and it is the largest annual equity index rebalancing event in the world. The second one is that there's a very high probability that major government pension funds and sovereign wealth funds, such as the Norwegian Oil Fund, the Swiss National Bank, and the Japanese Government Pension Investment Fund, which is the largest in the world, will engage in their annual mid-year rebalancing next week. Now, it's been determined by a number of sources, but JP Morgan most recently published an estimate that this could result in net equity sales of up to $150 billion, which is an extraordinary number, certainly the largest we've seen in years. And finally, there's several major buy-right mutual funds out there that are going to be forced to roll their hedges out to the September quarter. And these are, $10 to $15 billion sized funds. There's approximately a half a dozen of them. And this is going to create a amount of notional value that's being traded in the capital markets that is in such a concentrated period of about the next week. It's absolutely unprecedented. And so what it does is it creates an environment that is ripe for problems. So, with that, I wanted to kind of just review our short-term view on the market. As all will know, we have been bearish on this market for some time. If we look back to mid-December, we actually went, neutral on the market at that point, and we told our subscribers and investors who are paying attention to what we're saying that now is a great time to be rolling your assets out of equities. We had thought at that point in time that the counter trend advance had pretty much run its course, and we thought T-bills would make the most sense. It was a very fat pitch, paying 5% to those who can be patient and wait this thing out. And for a while we were looking pretty good on this trade up until about 2 weeks ago, where we saw a breakout here above 4,200 in the market's run. Well, that caused us to reassess our count. And based on the current preferred count, we see primary wave 2 is kind of a counter trend advance that's now been tracing out a double zigzag, WXY corrective waveform that we've labeled. Now, there is a potential alternate count here as well. And that alternate count is that we're looking at a unusually large degree running flat in the middle, where we have an ABC single zigzag. That matters a lot less than the fact that we think the market is carried into its terminal point. Last week, price action in the S&P 500 took out a whole cluster of really formidable resistance, which suggests that if Friday's high did not mark the top of primary wave 2 up, then we could see a challenge at the 786 retracement level that comes in on the S&P at 45.34. Now, that's not guaranteed. It is an area where we do have a couple of other wave relationships, one in particular where if the WXY pattern that we've traced out here is correct, then Y will equal W at 45.13, which is just a few points below the 786. However, we did see the index close just below the S&P 44.26 level, and that's where minor wave C equaled minor wave A within intermediate wave Y, and that has since reversed below a minor trend line. So, again, regardless of, what actual patterns being traced out, what's important is that primary wave 2 is near its terminal point, and once primary wave 2 tops, prices should reverse hard down to new bear market lows as primary wave 3 unfolds. We will know that this is happening when we experience a daily close below S&P 4299. That would suggest that primary wave 3 down has begun, and a weekly close below S&P 4186 would confirm it. We would then look to go short below S&P 4186. In the interim, we continue to hold T-bills. We do not think we're in a new bull market. We do not think that there is a dramatic amount of upside left in the market, maybe 2% tops if we haven't already put in that wave 2 high. With that, we're going to just invite you to take a look at our website at jwhinvestment.com. Follow us on Twitter at alpha_insights for more information on how we're thinking about the market. And of course, if you're interested in our monthly newsletter, check us out on Substack at hugeinsights.substack.com. Again, I want to thank everybody for watching today and wish you all the best of luck trading.